Multifamily Investor Nation. Thanks for joining us today. We're going to give each other a few minutes just to let everyone in the room. Excited for today's topic. Hope you are too. Let's see, as people are coming in, why don't you drop in the chat? Let me know where you're listening in from. I'm actually out here at the Best Ever Conference here in Salt Lake City. And I doubt anyone else are enjoying the conference, but let me know where you're from in the chat. Always curious to hear where people are listening in from. Let's see, we've got okay, we got Florida, we got Texas, Laguna Beach. All right, getting close to my territory. I'm actually in SoCal myself, out of LA, Denver, Boston, Vegas, some more Florida, South Carolina. All right. Looks like we're listening from all over the place, all different time zones. That's great. All right. Well, as people are rolling in here, I want to let you guys know that I'm actually the manager for strategic investor partnerships here at passiveinvesting.com. You can read a little bit about me in our Meet the Team bios that we have at passiveinvesting.com. And while you're there, don't forget to take a look at our current offerings. We do have some current offerings that are open for investment right now. If you'd like to learn a little bit more about that, make sure you're part of our Passive Investor Club, and there's a link there as well. I'm going to be dropping a QR code later at the end of the presentation as well. If you would like to join our Passive Investor Club, best way to keep in touch what we're doing out here. So, all right, with that, and also keep the chat up and handy, because I'm going to be asking for a lot of interaction on the chat as we go through this webinar. Like we mentioned, it'll probably be about I don't know, 25 minutes or so. We'll have some Q&As also at the end. If you'd like to drop them in the Q&A box during the presentation, that's fine. Our team will be answering some of those as they're able to, and for the rest of the questions we'll save towards the end, and I will address those at the end. So feel free to use the Q&A box and make sure you're responding to me on the chat box, because I'm curious to see what y'all are doing out there. All right, so let's kick it off. So welcome to this week's Multifamily Investor Nation webinar. Again, my name is Chad Zdenek. I'm the manager for strategic investor partnerships at passiveinvesting.com. And today we're going to be talking about moving from passive to partner and how to co-GP in real estate syndications. So in the chat, let me know what the audience is here. Give me a +1 partnered as a co-GP on syndications, and give me a 0 if you have not. Just curious to see where everyone's at. I imagine we're going to have a mixed bag with that, but just always curious to see where people are at. Okay, so we've got some people that are looking to take the first step. Got it. And some people that have done some co-GPing before. Perfect. It's kind of as I suspected. So, all right, well, I'm going to curious to see what people are doing, but let's go ahead and move on. Talk about what we're going to be going over today on the agenda. We're going to be going over, I'll give a brief introduction about myself. We're going to be going over what does a co-GP do, because there's lots of different things that a co-GP can do. And as you can imagine, it can be and should be a lot more than just capital raising. We're going to talk about what the steps are to take your first partnership. And then we're going to go over some common challenges that co-GPs run into. And I'll be speaking from experience in this department. And then we'll talk about the differences between raising for a debt fund versus an equity deal. A lot of debt funds out there right now, and a lot of investors, frankly, looking for debt funds. So we're going to be going over that as well. And then I'll give you some pro tips for a successful partnership raise, because raising is a big part of what co-GPs typically do. So a little bit about myself. I've actually been a GP either as a lead or $150 million of multifamily and self-storage properties. That would be throughout 22 properties in different states with 4 different operators. So I think it's a pretty good experience that I can share with you guys today on the webinar. Super excited to kind of share and let you know what I've experienced over that. I'm a licensed general contractor and professional engineer. As I mentioned, I live in Los Angeles, born and raised. And yes, I have done real estate deals in Los Angeles, but we'll save that topic for another webinar. A lot of lessons learned trying to do business in California. And as I mentioned, I'm the manager of strategic investor partnerships. That's my family. I've actually got 5 kids. The oldest one that graduated there is actually off at Penn State right now. And any Penn State Nittany Lions? We are, right? That's what I've been learning. So yeah, my oldest will be 19 this month, and my youngest there is 3 years old. So we're just barely getting out of the diaper stage. This was learned on trying to be a dad for 4 daughters and a son. We'll save that one for a different webinar. All right, well, let's continue on. So let's break it down. Like, what does a co-GP do? So I thought it'd be helpful to start at the top and talk about all the different types of roles that a co-GP could do, and then also like what percentage of the GP capital stack or GP cut of the deal that you would get. So, and this does vary quite a bit. So these are just really kind of rough numbers right now. But it can vary a lot depending on the deal, depending on the sponsor and whatnot. So when we say sponsor, that's generally going to be the lead GP or the KP, the operator, right? All those terms are fairly interchangeable. And they'll take generally 25% plus quite a few of these other items in here. Capital raising, capital raising and investor relations are about 30%. I should have kind of put those together, but generally the same people who capital raise will do the investor relations. Although when it gets to large organizations, it might separate a bit, but generally that winds up being about a third of the GP split. We have deal sourcing, due diligence. So those are like the people that find the deal. And then due diligence would be like a lot of third-party costs that are in there also. Third parties that you might be working with on due diligence, property managers, things like that, at about 15%. Asset management, about 10%. And there's also a fee that would be associated with that moving forward. I'll get into that a little bit later. And then loan guarantor, this can vary quite a bit depending on the size of the deal. Anywhere from probably, as low as 3% for larger deals, and it's going to be a bigger percentage on smaller deals. And then you've got your EMD money, so the earnest money deposit that people are putting down. That's the money that would go hard after your contingencies are removed during escrow, right? So generally, you're going to have different hurdles that you got to meet or different releases that you have over time. Most common one would be like your inspections period. Again, that varies a lot. It could be no inspection period up to 30 days or maybe even 45 days on the outside, depending on the deal. And also depends on the market. That'll change over time. If you were buying deals in 2020, 21, let's say 22 maybe, a lot of it could have been a 7-day inspection period. So super tight, or no inspection period and people coming in with all cash, right? Whereas today things have slowed down a bit and there's much longer inspection periods. So you have the EMD money that's associated with that. So here it is in a pie chart, just so you can kind of see how it lays out in this example. And again, these can vary a bit. Two takeaways here, probably realizing that on the capital raise side, because I know a lot of people are interested in the capital raising side of things, that would be combined with IR, generally speaking. And the other takeaway would be that the sponsor is going to end up doing much more than just that 25%. So the sponsor will end up with more than 25%, but it's because they're doing these other parts of the pie that I'm referring to. I just want to split it up to kind of make it more clear on all the different roles. And there's other roles besides this too, smaller things, but these are the main things that I've found in the deals I've been doing. The compensation structure, we talked a little bit about this earlier. So, and again, this is going to vary by market cycle. It's going to vary by asset class, but generally maybe a 6 to 8% preferred return, and then anywhere from a 50-50 to an 80-20 split. And we talk about split, that's like the LP versus GP split, or promote, as you might have heard it referred to as. And then some of the fees down below, you can kind of see there, generally a 1 to 3% acquisition fee, 1 to 3% disposition fee, and about 2% asset management fee. And that could be 2%. It could be based on equity raised or capital raised, or equity in the deal, or it could be on gross revenue to the property. So that can also vary a bit depending on how that's calculated. The acquisition and disposition fees are generally going to be on the sale price and purchase price. So, and then lastly, you're going to have the time commitment, right? What workload do you expect? This is a big one. Something like asset management, you could be doing that for 3 years, 5 years, 7 years, right? It could be a long time that you're doing the asset management side of things. The due diligence, deal sourcing, obviously that's one and done up front. But keep in mind, even like deal sourcing, you could be finding and working through a lot of deals and even doing due diligence, but those deals might not close, right? So that happens a lot, right? You'll back out of the deal during your contingency periods, not lose any earnest money, but that money that you spent on deal sourcing or due diligence, that's going to be a sunk cost at that point, right? You're not going to be getting a refund on that. So that's something always to consider. Obviously, investor relations is always ongoing. Loan guarantor is generally going to be upfront, but when you're doing refinancing or you're doing your your annual docs that you got to send to the bank, things like that. So your loan guarantor can be like on and off over the course of the hold period. So I think it's really important to when you're thinking about what kind of compensation you're getting for the role that you're bringing to the table. Why don't, and also just out of curiosity in the chat there, why don't you drop in the chat what type of roles you've personally done as a co-GP or on your own deals that you've done without co-GPs. Just curious to see what people's background is on that. When you're a solo GP, like I've done on some of my deals, you end up doing all of that. So it's a great way to learn, but it also takes a lot of time. And you're not going to be doing big deals that way, I'll tell you that much, because even smaller deals, a few $1 million, I'd say like the 1 to 5 or maybe up to $10 million on your own, you're going to learn a lot. So just curious what everyone's been doing. So we've got all LPs. EMD is earnest money deposit. That's basically the money that goes hard after so you have inspection contingencies, your financing contingencies. So it's all the small print that's really important that's written into your PSA or your purchase sale agreement. And you'll say, okay, we've got, a 14-day inspection period. We've got a 30 or 45-day financing contingency period, which means if you can't get financing in that 30-day window, let's say, you can get out of the deal and you don't lose any of your earnest money. And there's a bunch of different contingency periods that are within escrow. Those are the two big ones that most people are concerned with, but there's a lot of other contingencies in there. So, all right. So yeah, we got a good mix in here. Loan guarantors, asset management, project manager. Yeah, I didn't really talk about property management. On these larger deals, it's generally third party unless you have a vertically integrated company. But yeah, property manager is a big one. Those fees would be on top of all that stuff that I was talking about. Because generally your property manager isn't a GP, although they could be. I have seen it done that way. Okay, perfect. So let's talk a little bit about the steps to your first partnership, because we do have quite a few people in here that are looking to make their first step into partnership. So the first thing would be finding the right GP partner, right? This is a big one. And so where does this happen, right? This is a really, really big part of it, especially if you're bringing investors into it and you're working with investor capital. You really want to make sure you find the right partner. And for me, I found this two places where I found this to be best. One is at conferences, and I've gone to a lot of conferences. In the last 2 years, I've done 30 conferences. So it's a lot. I've been on the conference circuit. Like I said, I'm at Best Ever Conference right now, and we got a booth downstairs. And thankful for the rest of the team for covering for me. But yeah, here we are, Best Ever Conference. I was at Raise Fest last week. I'll be at another conference in Dallas in 3 weeks. So a lot of conferences, and you got to remember, it's not one and done at these conferences, right? It's you really got to keep going. You got to keep showing up to really start to build those relationships. So that would be a big one. The other one that I'd highly recommend is like mentorship groups or different organizations where you have like mastermind groups. That's also really big. Personally, I'm a part of 3 different masterminds right now. And that's a great way to really build deeper relationships. And it's also a great way to compress time frames. So most people, if they're smart and they work hard, like you can figure it out on your own. You will be able to get there, but it's going to take you some time. So if you wanted to compress time frames, I'd highly encourage you to invest in yourself, join a mentorship program, join a mastermind. Multifamily Investor Nation is a great way, these webinars and joining your local meetup groups and really trying to build those relationships. It's tough to know who you want to partner with unless you have a deeper relationship with them and you've kind of been watching them from the sidelines of what they've been doing. The other thing I'd also recommend is investing in deals as an LP, if that's something you're able to do. I'm newer to the team at passiveinvesting.com. I just joined last year, but I've been investing with them for almost 5 years, right? So I'm personally invested in four of their deals, and I really got to know the company very well from an LP standpoint before I made the ultimate commitment and officially joined the team. So you can see how being an LP can really help a GP, and especially if you're engaged, you're asking questions, you're interfacing with your contact at the company, and really getting to know the company, right? And there's going to be challenges along the way. It's not all going to be roses and rainbows. You're going to have problems. Every GP sponsor does. A lot of us are having issues right now with where the market's at. And it's good to know how are they handling those issues, right? So some of these relationships we talk about do take quite a bit of time. So let's go on about vetting them, right? So this is probably a little bit earlier on in the process, and what key questions to ask. So I found that the biggest things to talk about with a sponsor is their experience and background. What type of asset classes are they doing? How have they handled bad situations? So when you're in a conversation with somebody and you don't want to come across as like interrogating them, but you could say, hey, Susie, tell me about that most difficult deal you've had and what you guys have to do to get out of it. Right. And any sponsor that's been around for a while, they've had these deals. All of them have had these types of deals. They're not necessarily advertising it. They're certainly sharing information with their investors if they're doing their job, but it's not like they're blasting it out on social media, right? Most of them aren't. But if you're having a one-on-one conversation and you're just intrigued to know, like, hey, how did you handle this, or what did you learn about it? Generally, they're going to open up to you and talk about that. And so I think it's pretty important to hear about how they've handled those situations because there's a lot to be learned when you're in the trenches and deals aren't going according to plan. There's a lot to learn there. You can also talk to other investors that have been in deals with them, right? or even better, other co-GPs that have sponsored deals with them. This is a huge one. If you can find a co-GP that has sponsored a deal that did not go according to plan, that's almost going to be the best referral, if you will, or best information that you're going to get. And keep in mind that you always got to, listen to everything with a grain of salt, but keep in mind that when you're talking to the co-GP, the co-GP could have been the issue, right? It might not have been the sponsor. I literally just gave a test. We had about 1,000 attendees last year, and my topic was the 4 unforeseen liabilities that when partnering with co-GPs. And it was all talking about how things went bad because of the co-GPs, right? Everyone focuses so much on the GP team and the sponsor and what are they doing and blah, blah, blah. But co-GPs have a very, very important role in this. And I've been through deals that have had serious issues because of the co-GP, so much because of the sponsor. So just keep that in mind. And you'll learn this stuff as you're talking with people. You'll certainly learn this stuff, but don't be afraid to talk about those things. Okay, structuring the partnership, I kind of mentioned on the previous screen, it varies quite a bit. And if you're working with an experienced sponsor, they're going to have the way that they typically will allocate things, but you're going to find that does vary on sponsors. Me personally, I've been in deals where it was a 50-50 split with a 6% pref all the way up to a 80-20 split with a 8% pref, right? In that range. Actually, I'll share with you my first deal. I did a 90-10 split, right? No pref, just straight 90-10 and shared everything. But it was my first deal. So anyways, so it can vary a bit. And then finally, SEC compliance and legal considerations. This is a big one. Especially, I know we have quite a few people interested in capital raising on this webinar right now. You got to be careful with that because you're not allowed to receive performance-based compensation from the SEC. You have to be doing other duties besides just capital raising, unless you're registered as a broker-dealer, and that's a whole different animal. And then legal considerations is a big one also. The SEC and attorneys get involved. So you do need to be pretty careful of that. I generally like to do, even if it's like an MOU, a memorandum of understanding, of knowing what are your roles going to be going forward. We talked a little bit about what your workload, time commitment is going to be going forward. It doesn't need to be a 20-page legal document for those things. It could be a simple MOU, like, hey, this is what we kind of agreed on. I'm going to be working on this. You're going to be working on that going forward. That can be really well positioned guardrails, if you will, to kind of keep you in line. And hey, this is what we originally talked about. You got to understand it's not going to have every nut and bolt that you need, but in these partnerships, there's going to be a lot of give and take, right? It's generally it's not going to be all black and white. So an MOU can kind of help you get those guardrails up, just so there's an understanding from the beginning of what to do. Obviously, your PPM docs are going to be the full legal docs that are going to govern everything, your subscription agreements. But MOUs can help because they'll talk about the things that that aren't in the PPM for who's doing what. So let's move on to some common challenges co-GPs run into. There's a lot of them. I'm not going to be diving into everything. I am curious of you that have done co-GPing before. Why don't you drop in the chat what your biggest challenge was on one of your deals? Just curious to hear what other people have been seeing. I'll be talking about my experiences here, but I'm curious to know what other people have run into. It can vary a lot. So, all right. So the first one, and again, speaking to capital raising, what happens if you don't meet your commitment? Now this can be a pretty serious issue, right? It can be a serious issue, especially when there's a lot of earnest money that's on the line if you don't close. So if you don't raise enough money to close the deal and you can't close the deal, then somebody's losing a lot of money, right? I was a part of a deal that we lost over $700,000 in EMD money. 100,000 of that was mine, right? So I put in 100K into the deal as EMD money, not my LP investment, but as a GP, and I received extra GP percentage for that, and we weren't able to close the deal. It's a whole nother story. Literally, you could give a webinar on that deal, but we lost it, right? So it was a lot of money. I lost 100 grand. So it's pretty serious, and it was because we had a big 1031 that fell out, so we didn't have enough money to close. Serious issue. But the big thing here, and especially if you're newer, either A, if you're newer to raising money, or B, you're raising money in an uncertain market like it is today. A lot of people are coming up short on this, and generally people are raising about 50% of, or even 40% of what they were raising 2 and 3 years ago, across the board. So you got to be really in tune with this. And so a couple things here. Communication is key, right? You want to try to under promise and over deliver, right? So if you think you could bring $1 million to the table, maybe you put your mark at 750, or maybe even a little lower in today's market. First deal, go a little bit lower, and then try to over deliver. The other key here is communication. So if you're coming up short, and you should know within a few weeks where you're really coming in at. And if you're coming up short, bring it up. Do not wait until the end. Bring it up right away. And in fact, even bring it up as you're tracking, like your first week. Talk to your lead GP and say, hey, this is where I'm at this week. I thought I'd be here. This is where I'm at. This is the plan moving forward. Like, you got to communicate with your GP team, because if you are, they can pick up slack in other areas, right? And you might have been a part of this. If you've had a deal where you've been, the GP that's brought on towards the end to help fill a deal, and it can happen. So if you're talking with your GP team, that can really help out a lot, so they can plan accordingly, right? They can lean on other co-GPs, or bring on other people, or turn to gap funding or transactional lending. There's a lot of different things they can do if they have time. You got to give them time. Misaligned expectations, this kind of goes back to the MOU, and it doesn't need to be anything formal, but I love having it written down, because when you're even on some of these deals, you're talking 3-4 years later, like, it's really hard to remember what you talked about or agreed on. It could have been 4.5 years later, because you could have been in escrow. It could have been a 6-month lead time for buying, right? So to avoid that, I would strongly encourage some sort of MOU. It could be an email back and forth, but generally I like to make it a little bit more official, but not necessarily a legal document. All right, I'm going to speed it up a little bit. I'm been talking a little bit too much. I want to make sure we end on time. So let's talk about the differences between partnering on a debt fund and an equity deal. Now, this is a big deal right now, because there's a lot of debt funds that are coming on the market. I actually manage all the co-GPs on our debt fund. So we've got about $100 million debt fund that we've been doing for almost 5 years. So we started doing debt funds before they became real popular, and people weren't doing equity deals anymore. But some big differences there, right? So just real quickly, on a debt fund, generally you're going to have lower risk, lower return, predictable income, shorter commitments, and more regulatory oversight. Like we just director just for our rehab wallet side of the business. That's our forward-facing part of our debt fund, right? So a person that just focuses on making sure that we stay compliant with all the banking regulations there. On an equity deal, generally you're going to have higher risk, higher upside. Your investors are going to want appreciation and depreciation. Capital is generally going to be locked in longer, and you have different SEC issues on the equity deal, right? So they're very different types of money. And frankly, right now, investors are looking at both, right? It's not one or the other necessarily. A lot of investors are looking at both. So let's continue on here. So let's get into some pro tips. And then again, drop your questions in the Q&A. We're going to be getting into those in just a minute. If you have any questions, let me know. I'll be going through those here shortly. Okay, so big one. All right. If you're talking about capital raising, do not start raising your money once you have the deal. These relationships take time. And it's the old banking adage. I love this saying. The worst time to ask for money is when you need it, right? And that's in the banking world. But a lot of that's very true also in the capital raising side for equity deals. You don't want the first time you reach out to somebody when you have a deal and asking for money, right? So you actually need to start this process way beforehand, right? You got to work on, as Dan Handford always likes to say, the know, like, and trust triangle. If you haven't seen him talk about that, you've got to check out some of those webinars because that's gold for investor relations, right? You got to start building up that investor trust early. You also want to leverage other people's track record. This is key for all those folks that put 0 in the chat box. And if you're looking for your first deal, you don't need to know everything. You don't need to have all the experience. That's what a partnership's for. That's why, we're doing bigger deals with partnerships and bringing good people together to take down these bigger deals, right? Focus on your niche, focus on what you're really good at, and then you leverage your partners, right? So when we've done deals, and we even do this like on our debt fund side, right? That we're actively bringing on co-GPs on our debt fund. I'll get to that later. If you're interested, let me know. But on those debt fund folks, we'll actually do a webinar side by side with that co-GP, and it's up. We have a co-branded deck between passiveinvesting.com and them, and we're presenting it as us. It's a partnership. So that person that joined us, they've most likely have never done a debt fund. We're the experts, and they're leaning on us for that experience, and that's okay. That's a partnership. You got to lean into that. Building investor relationships. Again, this is going back to that first bullet, long-term focus, not one-time asks. You want to think of yourself as a farmer, as my good friends over at the Real Estate Guys say, a farmer, not a hunter, right? A hunter will go out, get a sale, and then move on to the next. The farmer nurtures that relationship. And you really want to have a farmer mentality in this industry to bear fruit over long term. Communication, again, is key. You want to keep investors in the loop. You want to find a partner who's really good at communicating their investor updates, right? Generally, these are email updates. You want to be very consistent on it. Like for us, we do it on the 20th of the month. Every single month, unless the 20th is on a Sunday, like investors know they're going to get their updates. And that's across all of our properties, right? Very, very important to just keep that consistency, whether it's good news or bad news, they know they're going to hear about it. So that's going to be key. And then you're going to be having a lot of conversations in between that one-on-one ask. That's what your IR team is going to do. It's very important to do that. So next steps as we wrap up here, and I'll get into Q&A. If you'd like to join our investor list for future deals, you can click the QR code there. Keep in mind, also, if you want to see kind of the education that we're putting out for our investors, it's a good way to kind of see what I'd consider us a top operator. You take a look at that, see what we're putting out there. And then also, if you'd like to schedule a call with me to talk about partnership opportunities on our debt fund, feel free to email me directly. Generally, we're going to look for partners who have raised at least $2 million and can raise at least $1 million for this debt fund. We do not pay performance-based compensation on that. We do a profit split, so it's set up a little bit differently. But that's how we comply with the SEC on that. But if you would like to talk a little bit more, email me. And then finally, follow us on social media. Facebook or LinkedIn are the best two options there, passiveinvesting.com. And thank you for listening. I'll go through now, kind of see the questions here. There's a lot in the chat, so bear with me a bit. And I've got the team kind of looking on some of this back end stuff too. So I know they've been helping out. Okay, for the deal sourcing due diligence bullet, does that percentage include the co-GP paying for due diligence costs, reports, etc.? No, generally it wouldn't unless they are, maybe they do that. But generally, no, those closing costs would be outside of that GP percentage. Okay, let's see, Brian, strange question. I happen to own largest apartment leasing company in Birmingham over the past 12 years. More than 8 apartments by a mile. This team sponsors last possible assurance of getting pro forma rents as well. Let's see. This is a tricky one, Brian. I'm not going to be able to answer this one. I know you put a lot of info in here. Hit me up on this one outside. It's pretty unique. But yeah, shoot me an email, chat@passiveinvesting.com. We'll talk shop on that. Yeah, there you go. Yeah, Brian, let's talk shop on that. Okay. Let's see. So that's all the questions in there. Let me double check because I saw some that went into the chat, and then we'll wrap it up. Communication cadence with other GPs. So yeah, that's a good question. So on co-GPs, generally you are talking more than once a month, unless you're like fully stabilized and there's not really any issues going on. Then it would just be the once a month. But certainly if you're working on value add deals, or you have, financing that's coming up, or let's say you have rate cap extension issues, things like that, occupancy issues. If you run into any trouble, then yeah, you're going to be talking with your co-GPs at least twice a month, but could be once a week. Because though you really want your co-GPs to be talking with investors, right? So they got to be on point, and once a month is not enough information for co-GP. So yeah, we are talking with co-GPs much more frequently than when we would be the LPs. Let's see, what are the top 3 conferences that you attend yearly? Good question. So interesting enough, this is my first time at and I know BEC is a really popular conference. But BEC is great. If you're a capital raiser, I think Raise Fest is great because that's primarily focused. So I'd highly recommend that one. Let's see, depends on what you're looking for. If you're looking for syndications, learning more about syndications, Secrets of Successful Syndication is a really good one. If you're big on financial freedom and kind of looking forward to more freedom type stuff, I think Limitless is really good, especially if you want to look at other asset classes besides just real estate, but focusing on financial freedom. That's another really good one. So yeah, I mean, I think those are some good ones to take a look at. Have I personally done business with hedge funds? No, I have not. All right, I think that's all my questions. Yeah, I think that's all the questions. Thank you so much for joining us. As you know, we took consistency a little bit, even in investor communications. Consistency with how you're marketing and doing webinars is also important. So, as a lot of you guys know, we are on the first Tuesday of the month, 11 a.m. So we'll be back here. It's going to be April 1st, 11 a.m. Eastern. Even though it's April Fool's Day, we will be here 11 a.m. So make sure you tune in for that. Consistency is key. And thanks for joining us. Appreciate it.